Hi, I'm Mel from the Money Study, bringing you another episode of our Take 10 challenge, up to number 18. Last episode we talked about credit cards, so this time we're just getting on to some of the other wonderful ways we can get ourselves into some sort of a pickle with debt. Anyway, before we kick it off, there's my disclaimer: facts and figures, information only. It is not advice. Okay. There's so many ways we can borrow money these days, and it's getting a bit too easy. We're all familiar with mortgages, and I'll be doing lots on borrowing money for your home. But this is all the other ways that we can fund things like store purchases and buying a car, and just all that little bits and pieces. And dare I say, people use probably the most inappropriate ways of borrowing money without really thinking what are the alternatives here. Personal loans are probably one of the most common ways we can just, get another $5,000, $10,000, or whatever the case may be. You might be able to get a bigger one depending on your scenario there. But of course, it comes down to, what are we paying, in that interest rate and so forth. Generally speaking, there's a difference between these personal loans. There's what they call an unsecured loan and a secured loan. Now, a secured loan means that, let's say we are buying a car and effectively the bank has got the right to take your car off you if you do not indeed pay the loan back. So the bank's got some sort of security. They're using your car as that security. If they don't have the right, it's an unsecured loan, and generally speaking, the interest rate is indeed higher. Okay. Then we get on to overdrafts or a line of credit. Now, normally this is associated with your mortgage, so that you've got a house, and with all that security that you've got, you own a big chunk of your house or a reasonable chunk of your house. Still might have a debt, but it literally means that we can indeed go further into debt by literally borrowing more money from the bank up to a subscribed, predetermined amount. It could be that you don't have any debt anymore. You might have actually paid your mortgage completely off, but you still want the flexibility of being able to access some money quickly. So you're getting to the point where your mortgage is nearly gone. You go and see the bank and say, look, can we set up here a line of credit? And it literally means they may say, there's 50,000, 100,000, $250,000, or whatever the numbers may be there, and you don't pay any interest on it until such time as you actually withdraw some money. So it could sit there for 3 years, and then all of a sudden you quickly need $50,000, and you just say, whip, okay, I'll just log in here into my line of credit, and I'll pull that money and move it into my savings account so I can then access it. And so you'd normally pay an administrative fee to have that facility, depending on the bank, $100, $200 a year or something similar. So it's not a bad way to have, flexible money. Now, you might already have a redraw facility on your loan where if you get ahead in the repayments, you can indeed pull back from that loan, the extra money that you're in front. So this is a similar sort of thing. It just means that you may not even have a loan any longer, but you've got this facility sitting there. Things like, it's similar to an overdraft where you're pulling out more money than is in the account effectively. And of course, overdrafts are quite good for businesses where their cash flow is up and down. One particular month they just need to go backwards, so they just redraw this money, knowing full well that there's going to be some money coming in to fill it back up again. But generally, a line of credit might be a little bit higher than a mortgage rate, so it's usually not a bad rate of interest if you've got because it's generally secured against the equity in your own home. So the bank feels quite comfortable in lending you the money. Consumer leases, so you are effectively renting or leasing things like computers or electrical appliances, TVs and washing machines and all that sort of stuff. The Harvey Normans of the world and so forth love these things because it all looks quite good until, of course, you don't pay it back within the prescribed period, and then start looking at the interest rates and so forth. So it can be a case that, if you're leasing it, it's over a period and it's fixed, if you've got a sort of a payoff, paying it in over a period of time, always with any of these things, just check the fine print as to see what indeed you're doing. But at least can indeed be expensive, if the regard that it all depends on interest rates. Now, if you're leasing something that you can claim as a tax deduction, then obviously if it's leasing for a business purpose or some other reason you can claim a tax deduction on it, then obviously that's going to reduce it. But I don't care if you get a tax deduction or not. Always look for the lowest way of borrowing money. If you've got some equity in your home, go and use the line of credit and overdraft. You still get a tax deduction. The tax deduction is not as big, but you're not paying as much. You're not paying as much in our interest. It's always just a comparison of the net result we've got to consider there. And so, sort of moving on from the lease, it's just an interest-free period where they say, okay, you can have all these goods, pay it off over this particular time, no interest whatsoever. Sounds wonderful, of course, until such time as you don't pay it off within the period. You've exceeded the period, and now all of a sudden it's like paying, credit card rates. It jumps dramatically from into the interest-free period. So if you're going to go into an interest-free period, then make sure you've paid it off within the period. I mean, in theory, an interest-free period is, if you can pay it off and there's no extra cost, perhaps you could have negotiated a better deal on the thing first if you didn't use this interest-free period. Offer them cash, up front. Could you've got a better deal? If not, and then they say, okay, interest-free, we're using their money. Your money could be somewhere else. So in theory, it's not a bad idea. But, and it's a big but, make sure it's paid off before you pay any interest. And of course, check there's no administrative fees. They may say it's interest-free, but then there's some sort of administrative cost that you're paying that you weren't aware of. Renting to buy, it's similar to this leasing arrangement, where at the end of the period and so forth, then you are effectively, owning the item. So you're just renting it over a period of time. It's theirs until you've actually made the last payment and so forth. But let's say, again, it's just a case of what interest rate are we indeed paying, and what sort of changes in the interest rate if we get ourselves into any sort of pickle along the way. I was talking about store lay-by to someone the other day, and we're sort of umming and ahhing whether stores even did lay-bys anymore. I always remember, when I was a child, going into the department store with my mother, and on a Friday, the day after payday, we'd stroll up to the lay-by counter, and she'd hand over, 10 shillings or whatever. I'm showing my age, aren't I? But yeah, it was quite a regular occurrence. Yeah, well, it was. Every Friday we used to go in, and there'd be something we'd have on lay-by. And it just literally means, the idea is that, yes, you can get the goods perhaps on a special, so that a special deal, and if the store allowed a lay-by on a special, not always, but the idea was they put it in the back room, so you're guaranteed to get it, but you don't get it until you've paid it off. Now, this is not very common these days. But anyway, I was talking to a couple of people about it, and a lady friend of mine basically said, yep, jewellery is a very common thing that you can put on lay-by. So it's still around. The advantage, I suppose, is that you don't pay interest on these things. It just means that you don't get the advantage of having the item, which sort of deferring our pleasure is sometimes not a bad idea. Just curbing our enthusiasm to get this item as we can afford it. So you just pay it off, and when it's finally paid off, it's yours. Okay. Now, the bank of mum and dad for the younger people, what a great source of income that is. If we can get a lump of money from mum and dad, it just depends obviously what mum and dad want in return. It may not be interest, but it may be some other thing that they've imposed upon you, which may be good or bad. But generally speaking, yes, borrowing money from mum and dad is usually pretty cheap. But if they even say to you, look, yeah, with no interest, please, and a few more pleases here, endeavour to pay it off. I always set up some sort of regular payment that you would both agree on, and then stick to it. Let the parents come back to you to say, look, you've done a good job. Okay, don't worry about it. You can have the rest. But for you to sort of assume that mum and dad can afford it, because not all mum and dad can afford it, especially if they've got 3 or 4 children. So it's a case of don't take advantage of them, because if you borrow money from mum and dad and say you'll pay it back and you don't, A, you've slipped a little bit in their thought of you, dare I say, and B, it's pretty immoral just to borrow money without the thought of paying it back. But thirdly, and probably most importantly for you, is that the second time around you need to do it, they probably will say no because you didn't make any attempt to pay it back in the first place. There's always exceptions to all these things, but don't take advantage of your parents. Payday loans, oh gosh, there's these payday lenders that you can just sort of, get online these days and get money within a few minutes. But blimey, and not a lot of questions asked. It's just, yeah, what are the fees? It could be even higher than a credit card, and that's saying something. Could be indeed. They are there for the absolute person who's in dire straits. They're taking advantage of people who are in one hell of a pickle. You do not use a payday lender unless you are absolutely desperate. And if we're absolutely desperate, let's go and see what else we could do before we have to go to a payday lender. That's for sure. Peer-to-peer lending is a new source of income. I suppose peer-to-peer lending is where if you go to your brother and get some money off him, but this is more to do with lending from people who you don't know, and using sort of online lending platforms. You put up there how much you want, and quite often it's why you want it, and then a lender will basically search around for an amount of money that people need that sort of equates to what they are doing. And of course, there's interest rates to be set and agreed payments and so forth. But I think that type of lending could indeed be, become more popular, especially the lenders understand that if they've got choice on who, what the security of the repayments are, and that can be verified, well, then it could be a good rate of return on their money. But of course, what happens if this person doesn't pay it back? Few of these platforms have certain criteria, and depending on the criteria, different interest rates and so forth. So they can take on higher risk, lower risk, and whatever goes on. But have a look if you're even remotely interested in either direction there. Car leases is interesting. I get a lot of people who I'm going to lease a car because I'm getting these tax deductions because it's a novated lease. In theory, they can pay for it in pre-tax dollars and so forth. But of course, it's not like superannuation, which we'll talk about later on, where there is no fringe benefit tax. A fringe benefit tax is where your employer has basically, given you something that you really wasn't normal part of your pay packet, and because it's a benefit, there's a tax on it. So if you're paying for it in pre-tax dollars, even though you might get a tax deduction, you've got to turn around and pay the fringe benefit tax. So it comes down to, are you actually any better off by the time you pay the fringe benefit tax in taking into consideration the tax deduction? Generally speaking, usually not a lot of benefit until you get into higher tax brackets. And understand that a lease, it could be some tax deductions, but I say with fringe benefit tax, are you really, a lease is still effectively you're borrowing money. Do your homework, would do a redraw be cheaper? And so it goes on even after the lease, after the tax deductions and so forth. Do your numbers, be a little bit wary of some of the leasing calculators online. You can go to a lot of just leasing advantages and so forth. You'll come up with some calculators. You can punch in your salary, punch in the value of the car and how much you're borrowing and all this sort of stuff. Some of the scenarios to indicate what your tax benefit would be a little bit skeptical. I mean, they are trying to sell you a lease, that's for sure. because some of the assumptions that they use as far as the cost of running and so forth of the car, it can be a little bit, brand new car, how much you really spend on it apart from, your regular grease and oil change. The maintenance costs that they sort of put down on some of these calculators, I think if I'm getting a brand new car, because cars these days, they just don't break down, hopefully, or if they do, it's probably still under warranty. But anyway, do you just say check the end result compared to could you borrow somewhere else at a cheaper rate rather than go through the rigmarole of the lease? Because obviously the biggest problem, of course, with the lease is there's a lease period. And at the end of the lease period, be 3, 4, 5 years, then if you just want to roll over the lease, you start all over again. If it's a case you want to buy the car at the end of the lease period, so you think, yep, good car, it's been reliable, I know its history, I'll just buy the car off the leasing company, which generally speaking you're allowed to do. It just comes down to the fact is what price. And normally I see this, what they call the balloon payment to buy that car. I'm not convinced that I couldn't go down to down to my local car yard with a pot of money. If I had a pot of money to pay from the leasing company, that I couldn't buy one cheaper with cash elsewhere. The last one, I'm actually going to do a little session on buy now, pay later, because it's now pretty predominant out there. We'll do a little section on that at some point, but I'm a bit concerned that the buy now, pay later are becoming, for the younger generation, what credit card problems was in my generation and the generation after. It literally where you can take the goods home and pay for them over the next few months. So it's really just a credit card, so to speak, but it's an arrangement with this company through the store. It's the fine print that will get you. The fine print will get you. So they sound cheap, they sound good, they're encouraged to use it. Every time someone wants you to borrow money, ask the question, why? Why do they want to borrow it? Anyway, we'll do some on buy now, pay later in another session there. So fun ways to get ourselves into debt, fun ways to figure out how we're going to pay it back. Talk again on another session.